Mehra is joining us live to discuss all of that. Good morning. Devina, help us understand what is your strategy for this market. There is so much fear at the moment. You can see a sea of red across screens, except when it comes to the commodity play.
Good morning. Yes, you're right. As I've said earlier also, we started out 2022 thinking it will be a very sector-specific, company-specific kind of story. And of course, one didn't know what Putin was thinking at the time. But it is playing out that way. In terms of, first, let me just step back a little as to what is the general impact of any kind of geopolitical crisis like this. And this is an exercise we did going back since the Sensex started. So basically going back 40 years and looked at all instances where something like this happened, where there was some kind of geopolitical crisis, whether it was the two Gulf Wars or various incidents in Afghanistan, or going back further, US bombing Libya or 9/11, etc. The thing was that a year later, you can't see that incident on the charts. And this, I'm not just talking the average or the median, but in every single instance. Only in 1993 in India did you have the market down a year later, but that was due to other reasons, not due to the this crisis. So unless, we, of course, you don't know. I mean, we are talking about nuclear power. If we go into World War III, then I think we'll have more things to worry about than only the markets. But other than that kind of scenario, where it does show up a year later often is crude and gold. So gold as the safe haven, and crude, coincidentally or otherwise, a lot of these incidents have been in the oil or energy intensive areas of the world. So that's the backdrop. But what it does impact, of course, is whatever it's getting directly impacted. And in the case of Russia and Ukraine, there have been things which have been very much directly impacted. So oil and gas, everybody knows about. There have also been a series of agri-commodities and potash, which goes into fertilizer. There have been metals from aluminum to palladium, where Russia or Ukraine are significant players. So all those things will have an impact on whoever is either the user or the seller. So that is why, in India also, you are seeing that playing out very much, companies which will be using these as inputs, either downstream chemicals from crude or commodities, will see margin pressure, whereas the people who are selling commodities, their benchmark prices go up. And the rupee depreciation is only helping further. The dollar price goes up, plus if rupee depreciates, then the seller of that commodity in India benefits, obviously. And rupee depreciation is something that I have spoken about on your channel much before this. So right from November, December last year, I've been saying that in 2022, to my mind, the big risk in India is the rupee depreciation risk, big macro risk, which is, of course, is flowing out of the inflation risk and the fact that you maintained a loose fiscal policy and a loose monetary policy in face of inflation, and in face of the fact that many emerging markets had started rate tightening much earlier, and also because rupee had been in a band for so long, which it has now broken out of. So this has accelerated the rupee depreciation, but that was always a risk. So the other segment besides the commodities is the companies which are either export oriented or import substitute, those kind of industries. So which is why IT services, which we have liked for a very long time, more than a year and a half, we continue to be overweight on. Of course, January, February were not particularly good for that sector, but we continue to like that. Then there are others where you have to be a little more picky, from chemicals, from textiles, commodities, of course, metals you've already spoken about, as well as the other commodities. So you have to, this is a pick and choose market. It's not a market where you can be gung-ho, and I don't think anyway the mood is gung-ho just now. So in terms of what investors should do, my advice would be that if you're looking to invest something, you can start investing maybe in 3 or 4 monthly tranches. That would be my advice. unless, as I said, the bets are off if it escalates into something much, much bigger. In global markets, the impact will be more again on countries which are directly impacted, which is largely Europe, besides the commodity play from banking to energy costs. Europe will be very much directly impacted. And it comes at a time when inflation and energy costs were anyway off the charts. Energy costs were off the charts in Europe much before even this crisis deepened.
Okay, so thanks for setting the background as far as our conversation goes. But Devina, just coming back to the strategy as well, right? There are many who will be scared. You've seen many, many market cycles, unlike many of our viewers maybe. So, when they're seeing the Nifty, the new calls for the Nifty, the way the stocks are moving towards 52-week lows, the way the FIIs are selling in, of course there is panic setting in. Is this a time to hold on tight? Is this a time to take cash off the table, or is it a bit late for that as well?
No, as I said, I think it might be even time to start getting back in with, if you were holding on to the cash. Of course, put risk control measures in place, because as I said, just certain sectors, certain companies are going to be hit badly. So have your stop loss levels in place. That I always say in all markets. Don't try to second guess the market. If your stop loss levels are hit, just get out and sit on the sidelines for that particular sector or stock, and see what the market is telling you. At times, you might even get back in a little higher price. That's also okay. So we've been following that strategy, and the other strategy which we follow in our portfolios is that when things are this uncertain, or even when things are a little uncertain, to have we take insurance through put options. So that is also something that we do. And right now also our equity exposures will be mostly hedged, because that is important. See, anything I talk about is only what I think is the highest probability event sitting today. But there are many directions in which things can go. And why risk control is important, I'll tell you. Like the day the war broke out, that February 24th, the markets fell 5%, our portfolios fell only 1.6. So that is where risk control kicks in, that anytime there is panic, then that is where you need to be also hedged. So whatever you are playing, you have to be careful which sectors, and the other thing is that have your risk control in place. So if the stock that you're holding has fallen 40% or something, or 50% or anything like that, don't just keep holding it all the way down, because many sectors and companies will be impacted for a long time. And it is not obviously small cap, mid caps, but even large caps. If you look at, there are whole sectors which have been underperforming for ages, and including some which are considered defensive sectors. FMCG, if you look at, for instance, it underperformed the up market in 2020 and 2021, and it's underperformed the down market also. So, look at the data. Don't just have impressions in your mind.
Yeah, absolutely. And I think, Devina, to add to that would also be this kind of spike that you're seeing across, commodity baskets, be it crude or, for that matter, agri-commodities. Look what's happened in wheat, look what's happened in soybean, and so on. And that's bound to add further pressure, I guess, on FMCG companies. We were chatting with Parley Products yesterday, and they said they have no choice but, when the inventory runs out, to pass on those escalated costs on to consumers, which thereby eventually will hurt their volumes at some juncture.
So yeah, it's already happened. If you look at the data, in the third quarter results, you saw margin compression across the board pretty much in FMCG, because both agri-commodities and crude-derived commodities had already going up, and the demand isn't buoyant enough for you to pass on the price increases. Then towards the end of the quarter in December, there were price hikes, and the last data I saw from the market was that the price hikes meant the volumes went down, not just that the growth went down, but actual volumes went down in several FMCG categories, because the fact is that a large chunk of the citizens are also still hurting. So they have no ability to absorb price increases. So it becomes a trade-off between demand destruction and margin compression. And now, of course, with the prices of the commodities going up even further, as you're saying, they may not even have a choice but to pass on at least some of the price increases.
Sure. Devina, you talked about IT services sector and the fact that your stance remains an overweight, more so after the recent correction that's played out in the IT sector at large, and stock specific in textile and commodity plays. Where else do you find opportunities that you can hedge your portfolio at this critical juncture?
You have to really, as I said, look at it stock by stock. So it is not. It's not going to be a very, very broad rally. So again, you have to look at stocks, you have to look at specific sectors. Even within sectors, as I said, for example, chemicals is a omnibus sector. So out of which in some places the output prices would be going up, in some the input prices will be going up. So you really have to drill down. And there are not going to be a whole lot of sectors at the moment, because between the inflation, which will again impact consumer demand in India, and margin compression in quite a few industries, you have to be careful. Capital goods is another area, which we have liked for a while, where the cycle had just started. So, again, it's a lag sector. So even if things go a little wrong, it hits capital goods a little late. And there again, because it's an import substitute sector, normally there is the pricing is sticky. Of course, on the other hand, sometimes they have fixed price contracts and the input prices go up. So that is something you have to look at. But that's another sector where we'd be overweight.
Devina, hi there. Good morning. Avan as well joining in. So you flagged off a number of sectors that you believe that one can look at as an opportunity in this market. But I wanted to also understand, your views on some of these new age tech stocks, because they were touted as the darlings of the market. We did see them get that very warm welcome. And then, as we know, things definitely went down south. Shankar has some very, vociferous views on this space. What about your take?
Well, my take actually has not changed that much even from the time when they were in that euphoric IPO stage. I remember my Diwali program where I was asked that what is the song that comes to mind at the time that time the Paytm IPO was on, and my answer was "Aage bhi jaane na tu, piche bhi jaane na tu, jo bhi hai bas yahi ek pal hai." So it was very clear that there wasn't any great fundamentals that were driving this. So it was, anytime you are in a situation where you're looking for reasons why, how to value this at this price, you are not starting from the valuation measure. You have the value and you're trying to find a valuation measure that fits. You are anyway in trouble. So on your channel itself at that time, which is before the markets crashed like this, which is just at the time of these IPOs coming in, Nikunj had asked me that if I put a gun to your head, which of these would you buy? And I said I still won't buy any. So much before the crash, that was my view. And reasons for that are a few. The first is we call them tech companies, but they're not really tech companies in the sense that technology is not the entry barrier. They are mostly either D2C companies or direct-to-consumer companies or platform companies. And there the only barrier has been how much money have you spent? And there being a listed entity is actually a negative. If you see at any of these, whether it is Paytm or Policy Bazaar or Zomato for that matter, all of them cut back actually on the marketing spend going into the IPO and post-IPO, naturally so because the public markets want to look at either profits or reducing losses. Whereas if your competition is still in the unlisted space, they have no such compunction. They can continue to spend. So all of them, or not all, but most of them would have seen market share going down going into the IPO. So that was one red flag. The other is that if you look at the international performance of such companies, whether it is Uber or DoorDash, etc., none of them had a very happy time, even though the interest rates were as low as they were in those markets at that time. So those are the things which people just forgot about. The other thing is that many of them came in at valuations which were not even the private market valuations. They came in at valuations which were several times, twice, thrice, four times their last fundraise, which may have been as close as 3 or 6 months ago. So nothing fundamentally would have changed in that time frame, except at that time the market was willing to pay that price. So I mean, kudos to the investment bankers and the companies that they managed to raise money at those valuations. But coming back to the question that even though they may have fallen whatever 50-60% or whatever the number is for each of them, doesn't mean that they have become inexpensive and should be bought. I mean, at the time of the IPO, some of the logic people were giving were wild, that this is cheap on 15-year out earnings. I mean, 15-year out earnings, who knows what happens to these companies? It is difficult enough even to project for a 100-year-old company like Hindustan Unilever, but to say that you are doing it for these companies is absurd. And the other thing, of course, is that many of these companies were pioneers in their field. They came in when those markets did not exist. So now when the markets don't exist, everyone doesn't know whether the market will ever be of a considerable size. But suppose you seed the market and you make it into something, then it's very easy for the second, third, fourth player to come in. So that's the other risk, that you have proven a business model, you have proven that the market exists. So there will be VC funds available for someone else other than the existing players. Some more might come in. And this is something, people don't think about enough, but it really struck me almost, this was like 20 years ago when Hindustan Lever, as it used to be called then, was entering atta and a few other food staples. And I happened to be meeting Amul to understand how these markets work. And I mentioned to them that they're entering atta. So, why don't you also look at something like the staples? And their answer was that we don't think, atta is a lucrative market in terms of margins, because, there is too much competition from the chakkiwala to the local distributor and so on. But if levers manage to prove that the market exists, then we'll also enter. Who's to stop us? So this is the logic of a lot of people sitting by the sideline. So you will see more competition. So I mean, coming back to your core question, no, just because they have fallen doesn't mean that they have become cheap and you should go out and buy them.
Out of whack valuations, as you're saying, Devina. But let's talk autos. And, the ground reality is that even we've seen the pace of the rural sales this time around, the outperformance that we had always witnessed, that seems to be in the slow lane right now. Basis what we're seeing on the prices of some of these large cap auto names, how have you read into, the numbers that have come in, and what's the outlook?
See, two-wheelers have been quite a disaster in terms of volumes. So more than just the signal for two-wheelers, it also signals to me how much of the economy is hurting. Because in two-wheelers, you have volumes which are at 10-year lows. Almost nothing in the country or the world can you look at things where the volumes are at where they were 10 years ago. So that shows you the extent of the demand destruction generally in the economy, and not just for the two-wheelers. This means that because two-wheelers is normally the kind of the first durable or close to the first durable bought when people are migrating into the middle class. So that clearly has stalled. And cars also, you see that while some of the high-end cars doing well, generally it is still not a buoyant market. And again, that this will get hurt by the commodity prices going up, because the manufacturers would need to pass on cost increases. So just when, at least on the four-wheeler side, things were looking little better, again, this whole thing will put a spanner in the works. So I don't think, those are going to be sectors which will outperform the market in general. You might find the odd stock or two, but that's how it looks.
Okay, Devina, right up front, you said maybe now with what's happening, it could also be a time to re-enter the markets to start deploying the cash. It has to be a very stock specific market. There's still so many moving parts. So can I ask you, have you bought anything new in the last couple of sessions? Have you taken advantage of this crisis?
Yes, we've increased our exposure to some of the commodities and metals. So that is definitely something we have done. And let me also tell you that a number of stop losses were also hit. So we just exited wherever that happened. So that's been the pattern for the last month and a half.
Okay. So that's what Devina Mehra has been up to in the last 1 month and a half with a special play as far as commodities go. It's always a pleasure talking to you. Thank you so much for joining us live today on the market to help our viewers understand just how to cut out the noise and navigate through it.
Thanks for having me. Enjoyed talking.